Hello everyone, and welcome to this latest video discussion as part of the RICS Tech Partner Programme. My name is Andrew Knight and I work within our thought leadership and analytics part of the organisation. My role is to look at the impact of data and technology and AI on the built and natural environment, and with over 110,000 members working worldwide right across that full property life cycle, from land use, planning and development, construction, valuation, brokerage, building surveying, finance, asset management, and indeed end of life. It's clearly a very rich canvas upon which our members are now taking advantage of the opportunities of data and tech and AI, but also having to manage some of the risks and downsides and the impact that these tools can have. And indeed, our members also work across all the main asset types, whether that's land itself, but obviously residential, commercial, alternative assets and infrastructure. And I'm really pleased today to have Phillip Martin join me from GeoSmart. So I guess before we get into the meat and drink of the discussion, it's always great to have a bit of a backstory of your backstory, Phillip, and a very quick introduction to what GeoSmart do in the market.
Yes, well, thank you, Andrew. My background, well, my name is Phillip Martin. My background is I'm a chartered accountant. I'm director of risk at GeoSmart Information Limited. My background is I've 30 years in the insurance and finance sectors. I worked for Marsh McLennan. I was a managing director of Marsh McLennan. I worked for Goldman Sachs and I worked in the Lloyd's market. And I joined GeoSmart about 5 years ago, really to look at the uses of the data for flood risk in particular, as flood risk is a major UK property risk hazard. And I think that's what we're going to talk about today. I dealt with a lot of compliance and regulatory issues, and as I mentioned, I'm an accountant, so I'm interested in the reporting and disclosure of the risks as well.
Indeed, indeed. And I guess, you know, before we delve into the detail, perhaps particularly about the flood risk, because it's almost a kind of an initially for participants in the market, I think a kind of a somewhat daunting cascade of this whole kind of ESG related disclosure that's come down, particularly from the capital markets and other kinds of regulatory pressures. I mean, has this been helpful, this kind of almost overload, dare I say it, of disclosure requirements and other kind of, as I say, regulatory requirements, as well as obviously doing the right thing and managing risk?
Yes, well, I mean, you're right. It's an interesting question. I mean, it can be argued that this cascade, although it is well-intentioned, has become somewhat of a victim of its own ambition and its initial success, because it has had some success. But by that, I mean that nearly all large corporates have invested heavily in developing ESG reporting teams and in obtaining data, sometimes of questionable accuracy, and have tried to create some level of consistency in numerous commercial segments. There has, however, been some pushback from some investors and others who may have struggled to see the wood for the trees and perhaps question whether the ESG data available gives useful insights for investment decision makers. One concern is that projects that score or that can score high ESG ratings may actually produce lower investment returns or returns that are more risky in financial terms. Another concern is that as you say, the range of disclosures can be quite daunting when supply chains are also taken into account. I mean, I guess the more complex the business, the more complex the ESG requirements. However, for property assets, at least we're able to identify a point location around which to assemble data. So in the property segment, it is more straightforward than in other segments. However, it's still early days in the ESG discipline, and improvements will certainly be made, including taking into account the feedback received from a wide section of the ESG user community. I mean, with regards specifically to flood risk, and I know we'll talk about some examples later on, we're now seeing multiple flood events across the globe in places where we really hadn't expected them. And in some cases, there are practical issues like the ESG expressions, such as return periods of, say, 1 in 100 or 1 in 200, are not well understood, and they're hard for regular users to gauge the meaning. And if users can't gauge the meaning, then the knock-on effect is uncertainty and how to respond. We'll talk a bit about that, I think. And but basically, as you say, as we're faced with some quite daunting climate change issues, it's obviously important that ESG disclosures are credible and actually encourage activities that lead to improvements in corporate behavior that is understood by investors and the end users of their products. So I think that's how I would answer that question, Andrew.
Indeed, and obviously, I mean, it's hard to move now without ESG as a topic being discussed, not just in the built and natural environment, but more widely. But I suppose, you know, if there are people listening who are literally on an ESG team in this property sector, you know, what are the key things that they should be thinking about in the context of flood risk and how that flows into the whole kind of ESG debate and reporting requirements?
Okay, well, good question. I think the UK flood risk is actually a great example of where ESG teams in the property sector can do quite a lot better than the current standard. And I think the best example of that is where improvements can be made, where there's currently too much reliance placed on very coarse flood models or other data sources that either have one of these two main problems, which is either they don't contain all of the flood components, e.g., they might have only fluvial, which is river and tidal risks, and they might miss out pluvial, which is rain, and many of them, nearly all of them, miss out groundwater. Or the data that they use does not actually use the property locations to impute the risk. For example, it's not uncommon to see what we call location granularity or location resolution to be quite coarse, in some cases several square kilometers. It's a big step to claim, in my view, much accuracy at the property location from that kind of resolution. And of course, that has knock-on usability issues. And obviously, as we just heard, you know, the data has to lead to, you know, use cases that are reliable. I mean, it is possible to obtain solutions to both these issues, and that could drive a better understanding and better ESG disclosures. So one of the areas that we can fix this, I think, quite quickly is with CPD, which is making the data users in the property sector aware of what is available and how to incorporate it into their data workflows. Obviously, you know, property professionals have a key role in encouraging good data take-up. And we can see that getting this right is important because most financial transactions that relate to a property do in fact carry the risk at that specific property. You know, there is a location there, and I'm thinking of things such as mortgage lending, the residential insurance market, the commercial property asset management sector, and commercial property lending and insurance. There also have been some recently reported issues that confirm that flood risk is moving up the agenda, and hopefully that's creating better awareness. So I think in the last 10 days, we have seen nationwide reported to be concerned about lending to high flood risk properties in the residential space. And obviously to make this decision requires good risk location data. Aviva reported to have declined to settle some commercial flood claims because of concerns about how to properly identify flood events when they occur in rapid sequence. Obviously, again, vulnerability will include location characteristics. You know, a big backstory is the Thames Water and all the problems they have, which is really an environmental problem. And you know, it's not just flood risk is the sole source of that, but you know, having flood risk vulnerability combined with infrastructure locations does require a good understanding in order to address the problems. And then finally, in the sort of public space, yesterday, the Financial Times published an article on the imperative to upgrade or replace the Thames barrier, and noted that as well as infrastructure, there's some £300 billion worth of residential property protected. Now, that certainly should be a wake-up call to property owners who may have put such concerns to the back of their minds. It must make sense to identify those properties which can benefit from local or backup resilience so that owners can have some control over their flood risk. Because when the barrier is upgraded or replaced, there will likely be some trade-offs between protection capability, the cost, and the residual risk to protected properties. A new barrier is unlikely to achieve, you know, a perfect solution, not least because tidal and river flood barriers don't protect against groundwater and pluvial risk. So I think, you know, there is quite an opportunity for the property sector to consume higher quality data to confront some of these issues that we're facing.
Indeed. And if we wind back slightly, if I may, to that whole kind of cascade of, the disclosures, and think of things like IFRS and, TCFD or SDR. I mean, how can sort of flood data actually feed into those disclosures? I mean, how important is that, and how does that support what is, obviously a large range of kind of metrics that people are now having to report on?
Okay, that's a good question, and close to my heart as a chartered accountant. I actually find IFRS reporting quite interesting, so yeah, I do have some things to say on this. I think the IFRS sustainability standards do push the ESG further, in the sense that they're starting to demand quantified data and quite specific data on that. Whereas ESG has tended to be rather more open in its scope. So whilst IFRS only applies to larger entities, by default, it's a legal requirement for them, and other entities who mostly choose to adopt IFRS anyway, and it's now become compulsory from 2024. So we'll start to see how its implementation affects the take of data. And the big question is, where is this data going to come from, and how do auditors obtain assurance that the data is appropriate, consistent, and accurate? So we'll also talk about data integrity. IFRS has a 600-page annex on types of disclosure. It's pretty comprehensive. Now, and as I mentioned the question before, high quality data is available. We are a supplier, but IFRS preparers, who may include the ESG teams, need to understand what high quality data is and what it isn't. And again, it's an area where CPD can deliver rapid improvements in property sector professionals' grasp of the available data and its quality and its uses. I mean, an example of that will be Red Book property valuations, which normally will form the basis of an IFRS asset disclosure because it's market value of that asset class. Those same Red Book valuation routines should include valuation stress for flood risk now, because that's something you have to disclose. So it makes more sense for the property professionals to undertake this exercise than it does for, say, ESG teams who are often not property professionals. To me, the ideal situation would be for internal consistency and understanding of good data for those valuation stresses. The TCFD regime has now largely been brought into the IFRS and has become more specific, and the expectation is that the standard of data used should be as close as possible to that used in that terrible expression, historical cost accounting, which is what people have been doing, for hundreds of years. And I would expect to see more rigor in IFRS disclosures than in TCFD. On SDR, which stands for Sustainability Disclosure Requirements, which is another comprehensive piece of disclosure regulation, it more affects the funds and the investment categories offered to investors, and I think it's discussed in a later question, so I won't go into it in more detail. I think the IFRS stuff is enough to hang this point about good quality data again, and I think we'll talk, perhaps you can ask me about data integrity or something. So I think that's the next.
Yeah, I mean, I think that was on the tip of my tongue, because you've mentioned the word sort of consistency or inconsistency in data integrity, and I guess one of the challenges I've sort of seen is the fact that people are getting data from various different sources, and so you've got this kind of patchwork quilt of if we're thinking particularly about flood data, where there does seem to be a danger that we're going to end up with obviously a reporting framework which is very good, but a danger that actually we have these multiple different sources where there isn't a single source of truth, as it were, and that there's no ability to trace back to the base data. I mean, how do you see that landscape at the moment, and what's the solution to that?
Well, I think you're absolutely right in the way you've described the situation. It is a bit of a patchwork. There are different ways of approaching this, but I believe that in an organization or in a commercial chain, data integrity means the ability of all the parties in the say the real estate chain to use the same data for their respective advice or services, so that they're all essentially using the same data to make their decisions and apply their professional knowledge. But there isn't one version of the truth, and there won't be until people understand the difference between high quality and low quality data. You might get there. I mean, it sounds quite simple, but as we've said, decisions based on a property should obviously be aligned. There are, perhaps 5 key players in the chain. We're talking about residential now, from estate agents to mortgage lenders. But in each transaction, there's only one consumer, and who's the buyer or seller, and there's only one specific property. So really, as I said before, the data should be assembled around the property, and data integrity to me means they can all have access to that, which does mean some changes to the quilt, as you say. Then we have this issue that even so, some of these professionals are not within the regulatory perimeter, the FCA, Bank of England regulatory perimeter, so there isn't a rule book for them, but they do have professional standards that are generally designed to protect the consumer, the buyer. So it makes sense for one of those standards to include common standard of data, and that the standard being designed ultimately to minimize the risk that a consumer or a buyer could end up unwittingly with a property that may become uninsurable or non-mortgageable or non-remortgageable in the future. So you think of the nationwide situation, that has to be avoided for future property owners. And I think, so that's in the non-regulated sector. So that would be your estate agents, surveyors, and conveyancers. And then in the regulatory perimeter, where firms do have to comply with the consumer duty. So there you're talking about mortgage brokers and lenders and insurers. But those people also have to comply with the Bank of England's climate change risk management standards, which are set out in another large tome called the Supervisory Statement 319. And this is where these firms who are in the regulatory perimeter are collecting this data and they're reporting it to the regulator. So, given that they have to report to the regulator, it makes sense that the values reported to the regulator are the same in aggregate as those advised to the consumer, so that there's one view of risk, not just one view of data. And data integrity therefore allows everyone to understand the risks and hopefully be able to cooperate better in devising methods or finance products to manage those risks for the benefit of the entire community. And that's something that's quite important now, obviously, personally, because I have children, corporately, we try to be good corporate citizens, and also because it is a daunting challenge. And if the patchwork remains and it inhibits, useful action, then community as a whole suffers.
Indeed. I'd like to probe a little deeper on something you've kind of alluded to earlier about the kind of data being available at a very granular level, kind of property by property. And obviously, in many situations, ESG teams are looking at big loan books or significant portfolios of assets. And I'm interested to hear your thoughts on the interplay between, modeling and reporting data at that kind of portfolio level, but also having that really granular property by property data and risk modeling as well.
Okay, well, the starting point for me would be that wherever you use property level or location specific data, it's going to improve the accuracy and relevance of either the model or the workflow. So a portfolio is really nothing other than a collection of the individual assets in there. So, and you have a problem automatically where in some financial products where there are millions of assets or items within the portfolio, that there is a lot of benefits to looking at mass risks from a diversification perspective. And perhaps if you're a lender or if you're more particularly an insurer, you don't really need to worry too much at a portfolio level about individual properties. But obviously, if you're the consumer, you do need to worry about that. So there is this trade-off there. And we believe that if you can have access to the property location data, then you should build your portfolio up from that. And we think that for example in the ESG teams, if they're required to give advice to the other professionals in their firm who are making decisions, then it's obviously important that the ESG advice itself is reliable. And if the data isn't good enough, then it will be really quite hard to demonstrate data integrity. And then you have this knock-on problem with the other functions. So if you're a property owner, then you've got operations, resilience function, you've got a valuation function. We haven't talked much about that, but obviously that property professionals, particularly in the RICS sphere, are largely charged with valuation tasks. And then you've got the investment, acquisition, and disposal teams. You've got the risk management team, and then you've got finally the financial reporting and disclosure teams. So they do all mostly use aggregated data. Obviously, there are points at which the property location specific data is vital, and to my mind, you shouldn't have a breakdown between those two. Otherwise, you don't really know whether the aggregate data is representing the actual portfolio. And I think for that reason, it's important that if it is the ESG team who take responsibility for this, it's important that their workflow becomes properly embedded in the organization. And we mentioned ESG, but we've really mostly talked about the environmental data and not the S and the G. The S and the G components, stand for social and governance requirements, and those two aspects do require board level engagement. And the boards are much more likely to engage where they can see that the ESG data is consistent with the other corporate functions that the board also supervises. So it's important that it doesn't get sort of, brushed under the carpet or treated as an add-on, away from the main event, if you like.
Indeed. And so much of our conversation is focused on the kind of responsibilities of ESG teams, but I guess the next point I'd love your views on is not only for ESG teams, but its value as other property professionals is around the difficulty of understanding now that obviously there are various different climate change scenarios depending on how many degrees we're going to end up above, pre-industrial levels, and how do those different climate change scenarios affect flood risk? How can people begin to kind of understand how those might play out and what they might mean for those, you say, different kinds of flooding? Because there's always that danger that people just focus on rivers or coast and don't forget the groundwater and the other kind of rainwater type effects. So how do you see those different outcomes, none of which particularly at the moment appear particularly rosy? How are they going to change the way flood risk develops?
Well, predicting the future is a risky game,
exactly.
and I'm not going to
It's always a
money
difficult question.
on predicting the future. But as you say, we need to try and look forward. And property risks are built into the location, and that is for the long term. So you have to have a forward-looking view. I'm going to sort of chicken out a bit and sort of point towards the Bank of England guidance on this one, because what we do is we take certain standards that are recommended, say, by the Bank of England or the CP18 rules that the UK adopted. So I've got to say, we follow a standard approach because I like the standards so that you can compare. And so what the Bank of England has set out, set various scenarios, but also some good practice about what you should do in those scenarios. So it is helpful, and they have considered property assets within that. What we can see at GeoSmart is that the path of UK flood risk really depends on global success in reducing carbon emissions and thereby reducing air and sea temperature, which are both significant drivers of flood risk. The Bank of England expects UK flood risk to double in the next 30 years under a no additional action scenario, which is the worst scenario. We use CP 8.5 as the worst case one, and that does show quite significant deterioration once you get beyond about 2050. The point is also that these risks are location related, and so it helps again to have this granular or high resolution location specific data if you want to understand how to respond. So, for example, in the worst case scenario, there's a significant risk in tidal, which will affect coastal and low-lying regions the most. or where there's a fluvial, which is a river estuary. So the Thames is a prime example. So, you know, this is a risk that's driven by exposure to severe events, you know, and as the article referred to the flood barrier. But there is an issue in that as sea level rises, there's also a risk of groundwater that cannot discharge to the sea. And so that increases the risk of failure to drainage and sewage systems on coastal or estuary towns, especially when those existing systems have been built 100 years ago or more. And then this is a more chronic sort of exposure that's harder to address because of the duration of the conditions. They may be permanent or semi-permanent and require mechanical intervention. And then in my list of woes, finally, the higher the rainfall, which is associated with higher air temperature, the higher the chance of flash flooding. And this is known to cause pluvial risk, which causes surface water runoff issues as local drainage becomes temporarily overwhelmed. In all of these cases, risk can and should be individually modeled, to your point, so that you can understand the flood actions and devise resilience options. And this is one area where the financial reporting dimension is a little bit limited, because in monetary terms, there appears to be no difference between types of flood. But in flood terms, the difference can be enormous. And it's the role of possibly the ESG teams or the property teams to get to grips with the kind of differentiation, and then make coherent disclosures so that the users of the ESG reports and IFRS statements can understand the consequences. And if that's achieved, then the users can make informed decisions about all sorts of property ownership and investment decisions, you know, including, should I spend money on making my property more resilient, or should I just buy more insurance and hopefully it will always be there? There's a bit like a sort of lease or buy decisions.
Yeah.
So in instances, there's some corollaries with the existing way in which other risks are managed within the financial services sector, at least.
I mean, on that point, I mean, are you seeing kind of ESG and sustainability teams being increasingly influential when it comes to investment planning and decision making? Because one could perhaps fall into the trap of just seeing them as passively, dare I say it, producing these reports, but not being part of that forward-looking decision-making process.
Well, I mean, it's a great point, and I mean, we're definitely seeing both. You know, we work with a number of property asset managers, and there's some sophisticated professionals in there. I would say that when they see the differentiation in the data, particularly when it's expressed in a location-specific way, you actually get to see the penny drop, and you can literally see the benefit of the ESG team now having something to say, which is really getting the attention of the asset managers themselves. And I think that's quite important. And I think that kind of sort of relationship has to come together, so there's an effective outcome in looking at the risks. And investment decisions, you know, it's not going to happen overnight, because investment decisions for many decades really been evaluated on historical cost accounting. I'm one of those, and that form of accounting doesn't really take into account non-financial criteria. And that there have been some attempts to impute non-financial, you may remember green accounting, but it kind of predated ESG, but it was never widely adopted. And we've got to avoid going down that same route again with ESG, because ESG has got to serve its users and not become a sort of low-value tick box routine. Again, the solution keeps coming back to increasing the quality of the actual data used in the reporting, so that it can be brought into the accounting and financial modeling routines. I note that some of the larger international banks have now, in their climate risk analysis, have now recognized that flood risk is actually a component of market risk, which is a value risk. It's also a component of credit risk, because obviously a lot of particularly commercial and residential properties are financed, and also liquidity risk, you know, which are the classic capital market, well, 3 of the 4 capital market risks, which are separately identified. And it would be there are some very sophisticated financial models or financial tools to model those sorts of risks. You understand about the interest rate risk, and it would be a big step forward if there was an equivalent approach to flood risks, so that the true cost of the risk could be better managed and not rely on a rather binary situation on insurance risk transfer, because as we've seen, the Aviva case illustrates, it's not necessarily always going to be available. And the Bank of England has made that case very specifically in its 2021 climate biennial exploratory scenario. And clearly, the better the climate risk data, the better will be the understanding and the pricing of products that insure or finance properties in the future.
Indeed. A final question for you, if I may, Philip. I believe in the spring budget in the UK this year, the Chancellor announced that the government is looking to regulate the provision of ESG ratings. So what's this going to mean for ESG, particularly obviously in the context of flood risk, with this kind of yet another kind of piece of regulatory framework around this whole area?
Yeah, I mean, this is a good question. It kind of relates to the very first question you asked me. Sort of half an hour ago, which was, how useful is some of this ESG, and we talked a bit about the pushback, and about some of the improvements that would come from feedback. And some of the feedback has been about greenwashing. You probably heard about that, and also sort of big bucket thing of people making claims of sustainability where those claims themselves cannot be sustained. And that's sort of caused a bit of a backlash against ESG. So one of the ways to solve that problem is to actually bring the rating of at least certain products into the regulatory environment. And so we see this with the credit rating agencies, which are already, quite closely monitored by the regulatory authorities, because if something is difference between something being AAA or AA has a big pricing. So this new regulations is also intended to create some level of independence between those people who give ratings or assign ratings and those people who then offer advice on how to improve the rating, such that there would be a separation, so you wouldn't be both the person or the organization providing the rating and then providing back to your clients information on how to either get to, perhaps to get around the rating and what to. And so, that's a good governance aspect, I think. And I think that that obviously takes the situation forward. I think it's sort of mostly in the corporate sector at the moment, although the application of a sustainability label should be capable of being applied to a residential property. Sustainability means the ability to withstand flood events, whether a house is efficient. And we've heard many people, including the Environment Agency, bemoan the fact that a lot of building in the last 10-20 years has actually been on floodplains. So it's quite hard to say a house that's built in a floodplain is going to score high on a sustainability rating. But at the moment, there is no such sustainability rating. And I think also that perhaps that notion can be applied to some financial products, such as insurance. For example, is it sustainable to expend resources endlessly replacing flood damaged properties or belongings over and again? Would it not be better to give credit where properties can demonstrate some kind of resilience? So there's quite a long way to go on the sustainability, and a lot of the focus actually has been on carbon sustainability or carbon load. It's now heat stress is now the as you say in sitting in the sun. Heat stress is now sort of the new poster child. But actually, some of these long-term chronic and acute risks of flooding really are going to require some kind of understanding of what's sustainable and what isn't. And the whole debate, I think, is really helped by the Financial Times article on the flood barrier, because it's a massive project and there will be trade-offs. And so perhaps the general public will start to understand what sustainability means when in the context of their own residential property.
Indeed, indeed. Well, it's a fascinating subject. We could talk for a lot longer on this, Philip. But for today, thank you so much for your time. I mean, the clear message is we need good quality data from the asset level upwards, don't we, to support all these very important decisions. And as you say, sometimes there are set trade-offs when we have to be realistic about what we'll do in certain situations. But as I say, for today, thanks ever so much for your time, and I look forward to catching up again in the future.
Thanks very much, Andrew.